So just what is capital gains tax? Find out coming up. Hey there, Keith Wilson with Wilson Financial Advisors, here spreading some financial tips to help you along with your financial journey. I hope you're having a great day. You know what? It seems like we are bombarded with taxes. You got income tax, estate tax, property tax, sales tax, and capital gains tax. So I want to take a little bit of time. Let's talk about capital gains tax. Now, capital gains tax that really can be applied to a lot of things: real estate, collectibles, and investments. But for this video, we're going to concentrate on capital gains tax as it pertains to investments. Now, with that, I'm not talking about your retirement accounts, your IRAs, 401ks. Those are tax deferred. I'm talking about pure investments that you hold outside of a retirement account. So let's talk about it. But before we do that, take some time, hit that subscribe button below, ring the bell so you'll be notified when I post other videos talking about personal finance. I'd appreciate it. So to put it simply, capital gains tax is a tax on the gain or profit of your investment. For example, let's say you bought ABC stock for $10,000, which would be your purchase price, or what we call cost basis. But let's say that $10,000 grew to $15,000. So now your gain on that stock would be $5,000, right? But that gain is only on paper because the price of the stock, it would continue to fluctuate. If you did not sell it, you don't pay tax on it. You do not pay tax on the gain if you don't sell it. This is called unrealized gain. It's all on paper because you really don't make or lose money until you sell the stock. So a lot of people, oh no, I lost so much money this month. Well, did you sell it? No, you didn't really lose it. It's only on paper. Or, man, I made a lot of money this month on my investment. Really? Looks good on paper, but if you didn't sell it, you didn't really make it. So now if you sold it at $15,000, that example, then you would realize the gain and you would pay that capital gains tax on that profit of $5,000. All right. Well, but how much? How much would you pay? Well, capital gains tax is either currently 0%, 15%, or 20%, and it depends on your tax bracket. Capital gains tax is different than income tax. So in 2021, this is how it works out. In 2021, with single taxpayers, if your income is under $40,400, or if you're married filing joint under $80,800, then for people in that tax bracket, the capital gains tax, 0%. Sounds good. If your income for single is between $40,401 and $445,850, and married filing jointly between $80,801 and $501,600, then the capital gains tax would be 15%. Now that's a big, broad range. Everybody else above that would be taxed at 20%. So most people are going to fall in the 15% capital gains tax rate. Now this 0%, 15%, or 20% is applied to the gain of the sale of that stock, or it could be other security. In this example, the $5,000 gain. However, it depends on when you purchased that stock or other security. So if you sold that stock or other security in less than 1 year from the date you purchased it, it then is what you call a short-term gain. Now, short-term gains are taxed at your ordinary income tax rate, which is typically much higher than capital gains tax rate. So when we talk about capital gains tax, we're more likely referring to long-term capital gain, which is anything you held for more than 1 year. But what if that stock you purchased went down in value and then you sold it, hey, then you would realize a loss, and you can deduct that loss on your income tax return. You can only deduct $3,000 of losses. However, the remaining balance of that loss can be carried over next year to offset possible gains. Some people, they will intentionally sell a stock or a security at a loss to offset a gain of another stock they sold for a gain. And this is called tax loss harvesting. But beware, if you sold a stock for a loss and purchased that same stock or something similar within 30 days, then you would run afoul of something called the wash rule and would not be able to write off that loss. So there you have it. The capital gains tax, which is taxed at a much more favorable rate than income tax. Now, obviously, tax rates are going to change, so keep that in mind. And as always, you got to check with your tax advisor to see how it affects you.